Right now, driving through any neighborhood in Metro Detroit, you're looking at millions of dollars in retirement savings that most people have completely forgotten they own. Your home is not just where you live. For most Metro Detroit retirees, it is the single largest asset on your personal balance sheet. And yet, the vast majority of retirement plans I see have no strategy for it. Not one line. Today I'm going to fix that. We're covering Pillar 4 of my 6-pillar retirement system, home equity strategy. I'm walking you through 4 main options: reverse mortgage, HELOC, cash-out refinance, and downsizing. By the end of this video you'll know exactly which path fits your situation. I'm Janine Davis. I'm a licensed mortgage loan officer, a registered Social Security analyst, and an independent Medicare broker based right here in Metro Detroit. I wrote the book You Work Too Hard to Run Out of Money, a complete 6-pillar retirement planning guide for Detroit retirees, and today we're going deep on Pillar 4. Home equity is simply the difference between your home's current market value and what you still owe on your mortgage. For many Metro Detroit homeowners who purchased a decade or more ago, this number has grown substantially, often $200,000, $300,000, or more. In my 6-pillar retirement system, home equity strategy sits as Pillar 4. It connects directly to your income planning, your insurance strategy, and your estate plan. If you don't have a strategy for it, you're leaving one of your largest assets without a plan. Option 1, the reverse mortgage. Technically a home equity conversion mortgage, or HECM. This is probably the most misunderstood financial product in America. Let me give you the actual facts. A reverse mortgage allows homeowners 62 or older to convert a portion of their home equity into cash without making a monthly mortgage payment. The loan is repaid when the home is sold, when you move out permanently, or when the borrower passes away. You keep title. You keep the home. You have 3 ways to receive the funds: a lump sum, monthly payments, or a line of credit that grows over time. The growing line of credit is one of the most powerful and least understood features, and used funds grow at the loan interest rate, giving you more access over time. 2 myths to bust right now. 1. The bank takes your house. False. You retain title. 2 myths to bust right now. 2. You can owe more than the home is worth. False. HECMs are FHA insured. You or your heirs never owe more than the home's value at sale. Reverse mortgages work best for house-rich, cash-flow-tight retirees. They're also powerful strategically, for delaying Social Security to maximize lifetime benefits, or covering healthcare costs without draining investment accounts. As your licensed MLO, I can run the exact numbers for your situation. Option 2, the HELOC. A home equity line of credit, a revolving line of credit secured by your home equity. Think of it like a credit card that uses your home as collateral, except at far lower interest rates. During the draw period, typically 10 years, you can borrow, repay, and borrow again. After the draw period, you enter repayment. You only pay interest on what you actually use. HELOCs work best for specific, one-time needs, a home renovation, medical expense, or helping a grandchild with school. They're flexible and cost-effective as long as you're disciplined about not overdrawing. The risk: HELOC rates are typically variable. When rates go up, so do your payments. And because a HELOC requires monthly payments, it may not be right if cash flow is tight. Key timing note: HELOCs are easier to qualify for while you're still employed. Apply before you retire, not after. Option 3, the cash-out refinance. This is where you replace your existing mortgage with a new, larger mortgage, and receive the difference as a lump sum of cash. It's unlocking equity while staying in your home, with a new monthly payment going forward. Here's how it works in simple terms. Let's say your home is worth $350,000 and you still owe $80,000. You might refinance into a new $250,000 mortgage, pay off the original $80,000, and receive $170,000 in cash, minus closing costs. To qualify, lenders typically look at your credit score, your debt-to-income ratio, and how much equity you have. Most lenders want you to keep at least 20% equity in the home after the refinance. As your licensed mortgage loan officer, I can run the qualification numbers for your specific situation and compare your options side by side. One significant advantage over a HELOC, you can get a fixed interest rate on a cash-out refinance. That means your payment is predictable and locked in, no surprise rate increases. For retirees who want certainty, that stability matters. A cash-out refinance works well if you have a specific large need, paying off high-interest debt, a major home renovation, or supplementing retirement savings, and you can comfortably handle the new monthly payment. When it's less ideal, if you're already retired with fixed income and adding a new monthly obligation would strain your budget. That's exactly the kind of analysis we do together in a 6-pillar retirement review. Option 4, Downsizing. The one that sounds simplest but carries the most emotional weight. Selling the family home, capturing your equity, and moving into something smaller, less expensive, and easier to maintain. From a purely financial standpoint, downsizing can be extraordinarily powerful. If you've lived in your home for at least 2 of the past 5 years, you may exclude up to $250,000 in capital gains from federal taxes, or $500,000 if you're married filing jointly. For Metro Detroit homeowners who bought 20 or 30 years ago, this exclusion alone can mean keeping hundreds of thousands of dollars completely tax-free. 3 questions to help you evaluate downsizing. 1. Do you have meaningful equity you could access after closing costs, commissions, and moving expenses? 2. Is your current home costing you significantly in property taxes, insurance, utilities, and maintenance, costs that would drop in a smaller space? 3. Are you emotionally ready? The family home carries weight. This is not just a financial decision. It's a life decision. And there's no wrong answer. Here's what separates my approach from a typical financial planning meeting. I never look at home equity in isolation. Let me give you 3 quick examples of how these 4 strategies connect to your bigger picture. Use a reverse mortgage line of credit in your early retirement years to delay Social Security to 70. That delay is worth up to 8% per year, permanently. Your home equity funded the strategy. Use cash-out refinance proceeds to purchase a guaranteed income annuity. You convert equity into a monthly paycheck for life. The refinance has a payment, yes, but the annuity income covers it and then some. Pillar 4 Funding. Pillar 5. Downsize and capture equity, then make sure your estate plan reflects the new asset allocation. How the proceeds are titled, where they go, and how your heirs are protected all live at the intersection of Pillar 4 and Pillar 6. If you want the complete home equity chapter, and all 6 pillars, my book You Work Too Hard to Run Out of Money is available now at lifestylesafety.com. Written specifically for Metro Detroit retirees who are tired of fragmented advice from advisors who only see one piece of the picture. And if you'd like to sit down together at no cost and see how your home equity fits into your complete retirement picture, I offer a free 6-pillar retirement review. No obligation. No jargon. Just a real conversation about your real plan. Schedule yours at lifestylesafety.com or call me at 313-450-9543. See you in the next video.